Good morning, my name is Fletch Heinemann. I'm a partner at Cooper Grace Ward specialising in tax and tax disputes. Whether you have to pay tax on a distribution from a foreign trust depends on a number of different factors. The first one to consider is your own residency position. So the general position is that if you are an Australian tax resident, you'll pay tax on amounts of income that are distributed from the foreign trust to you. The other thing to watch for is that if you're an Australian tax resident, you may also need to include distributions of capital from a foreign trust in your assessable income. There are different rules if you're a non-resident or a temporary resident. What you need to know about Section 99B is that unlike most provisions in the income tax legislation that tax income, Section 99B actually taxes a capital amount. So if a foreign trust distributes an amount of capital to you, which is typically the funds of the trust, for example, that have accumulated over many years, then actually that amount can be included in your assessable income. There are some exclusions to this, however. The main exclusions relate to the amounts of the original corpus of the trust. So, for example, if the foreign trust was set up in, say, 1980 overseas with $100,000 as the original corpus of that trust when it was established, then if there is then a capital distribution to you in Australia, you have to reduce the amount that's included in your assessable income by that corpus amount. Sometimes if the trust has existed for many years, the corpus amount will be quite small compared to the rest of the trust. However, if the trust is quite recent, sometimes the corpus amount may be all of the trust, in which case no amount would be taxable under Section 99B. If the trustee has paid tax in the overseas country, you'll need to check that if you have to include an amount in your assessable income because you've got a distribution from the trust, whether you can then get a credit in Australia for the tax that the trustee has paid to the foreign tax authorities. What we find is that the most difficult part of this is actually getting the evidence of the tax that the trustee has paid overseas. So it might require some digging to get this information first. Once you have that evidence, you'll then be able to work out how much of a foreign tax credit you're entitled to, if at all. There's a particularly difficult issue for people immigrating to Australia that have assets overseas, and it may not even be their assets. Often we find that clients come to Australia and then will later receive a distribution of capital from, for example, mum and dad's trust overseas. Unfortunately, there's nothing in the legislation that prevents that amount from being subject to tax in Australia. So, for example, you could have a trust that has been operating overseas since, say, 1980, and the client immigrates to Australia in, say, 2016, and then gets a distribution of capital from that trust. Unfortunately, there's nothing that caps the amount that has to be included in your assessable income to any amounts that were earned after 2016. So it's really important that if you have people who are intending to come to Australia, to immigrate to Australia, and that they may have distributions from a trust at some point, that this is managed before they actually come to Australia and settle. Thanks for watching. If you have any questions, please feel free to contact us. We're always happy to help where we can.